Hello, clients and friends. This is Craig Lewelling from U.S. Investors International, and it's my pleasure to present our first quarter economic review. As you watch this, please keep in mind it is a review of the months of January through March. Since then, April has presented some very challenging times for investors. So we'll be addressing that as we go along in this presentation the best we can. So let's begin. At our firm, we partner with clients and believe an educated client is our best client. While we always try our best to help you with your finances, we believe that knowledge is power. One of our missions is to share any knowledge with clients to help them make an informed decision. As you can see from the charts, the first quarter was a roller coaster ride for investors. We entered 2025 with continued strength from 2024, and in mid-February, equity markets made another round of all-time highs, but then after two robust years for equities, investor sentiment quickly did an about-face. We've been talking about this for the last couple of years. We've been overdue for a market correction, and now, in fact, they've hit bear market territory, but it's still uncertain whether we're really headed for a recession or if this is just going to be more of a mild, softer one. Uncertainties and changes quickly dominated the headlines, and equities experienced a quick downfall during the last 6 weeks of the quarter. The transitional period between new administrations typically brings adjustments, and with those changes comes the volatility. As promised, the United States new administration has an aggressive agenda, and President Trump's first priority was to implement quick and sweeping changes. Equities reached the uncertainty during the quarter by going near or into correction territory as investors became wary, particularly over the global trade wars, new tariffs, and their effect on the economy. Again, we're well down the path here. We know what's going on with these trade wars. We need to start seeing some agreements here soon, or this market will continue to be very volatile, and we could see more downside to this yet. As the first quarter's end, the S&P 500 was down 4.6% year to date, and the Dow Jones Industrial was down 1.3%. Good news arrived with better than expected inflation numbers, which showed that U.S. inflation decreased to 2.8% in February, down from 3% in January 2025. We now know for March, they went down to 2.4%. So inflation is heading in the right direction in terms of getting towards that 2% number, but that still has not triggered the Feds to lower rates. And that's really what Trump is trying to do, is get the Feds to lower the interest rates. He wants to bring prices down and lower rates. That's been the goal here. And on top of getting better trade agreements with other countries. The core CPI, which excludes food and energy prices, is often viewed by economists as a better gauge of future inflation. It was 3.1%. Their increase in shelter costs in February accounted for nearly 50% of the overall CPI rise. While inflation is gradually moving towards the Fed's 2% target, we are still not there yet, and that's true even today as we're in the middle of April, almost towards the end of April. After reducing the federal funds rate 3 times in 2024, the Feds felt it appropriate to keep rates stagnant at 4.25 to 4.5% at both of their first quarter meetings. The Fed is vigilant in monitoring key economic indicators, including labor market conditions, inflation pressures, and expectations, as well as financial and international developments. With 2 Fed meetings scheduled for the second quarter and 4 more planned for the second half of the year, the Fed has indicated that further rate cuts will be contingent upon inflation trends and economic conditions. In their last meeting, they kept everything as is. Bonds have an inverse relationship with interest rates. When one goes up, the other usually goes down. Yields ended the quarter slightly lower than where they started. On March 31st, the 10-year note was 4.23%. The 20-year Treasury yield ended the first quarter at 4.62%, and the 30-year note closed at 4.59%. This came from treasury.gov. The current outlook for bonds in 2025 remain unclear. Uncertainty about interest rates, inflation trends, and clarity on tariffs currently remain. Therefore, you can expect bond yields to fluctuate. Bonds can be part of a well-diversified portfolio because historically they have lower volatility than stocks. A lot of people have asked me, why are bonds hitting a top? Are where our yields are they close to the bottom. Again, it's just too soon to tell until we get some more clarity on all these tariffs and where they're going. But again, I think we need to start seeing some agreements with some of these countries sooner than later, or the market's going to continue to stay very volatile. The transitional time between new administrations typically brings some uncertainty, which leads to volatility. This new administration came in as it indicated it would, and President Trump's first agenda was to make quick and sweeping change. Optimistic investor sentiment quickly waned, and some of the more aggressive campaign promises began to materialize. Towards the second half of the quarter, investors became wary, and concerns over global trade wars and the tariffs created very high levels of anxiety. That still exists very much today, and the longer this goes on, again, those anxieties stay with us and grow. Now let's briefly address the elephant in the room. Tariffs. Right now, you cannot turn on a news report without hearing about tariffs. That's still true right now. But what exactly is a tariff? Are they a good thing? Are they a bad thing? Tariffs themselves don't necessarily cause volatility. It is how they are applied and an investor's reaction to them that can create instability in equity markets. Tariffs have been used by many countries, including the United States, for centuries. A tariff is a tax on goods that are imported or exported between countries. They are a type of trade barrier that can raise availability prices and reduce the availability of goods and services. How do tariffs work? Companies that import foreign goods pay the tariff to the government. Tariffs can be a percentage of the value of the imported product, or they can be a flat tax charge on each imported good. Why are tariffs used? Tariffs are used to protect domestic industries and jobs. They can also be used to punish or discourage actions a country disapproves of. What are the effects of tariffs? Tariffs can increase the cost of production and the cost to the consumer. They can also create tensions between countries and lead to trade wars, and they can negatively affect the stock prices of companies that rely on imported goods. The new administration proposed tariffs, and they have become a nightly news agenda item and a widely discussed topic, with sizable concerns about their potential impact on the U.S. economy. The Trump administration announced multiple tariffs. The administration feels it will protect domestic industries and boost sales of American-made products by taxing imports from all countries. The White House has suggested that these tariffs will grow the American economy, help reduce our deficit, and create jobs. The administration is claiming that tariffs are reciprocal and discounted to the tariffs that other countries place on the United States. During the first quarter, when these tariffs were discussed on the S&P 500 dipped into correction territory. As President Trump began getting specific and the administration was announcing enactment of the tariffs, in the first week of April, U.S. and global equities retreated in a quick and alarming way as of this update. U.S. markets have reached bear market territory, which is generally defined as decline of 20% or more from a recent high. They hit 20% or more down. It bounced back up strong in one day. And in the last few days, probably the last couple of weeks, you've seen them slowly come back down and almost retest the lows, not quite, but close. Today, they've bounced back up a bit. We think this volatility will continue until we see some sort of agreements with some of these countries. As of now, the level of uncertainty is high, and we do not know the specifics as to how much this will affect the economy and inflation moving forward. We remain committed to keeping a watched eye on these tariffs and their effects on clients' investment portfolios. We understand that the recent volatility of the stock market is very uncomfortable. The combination of a market correction and political uncertainty has been mostly helpful for media outlets who use fright as a method of attracting viewers. It is easy to become concerned and alarmed when equity markets move down swiftly, but focusing on what you can control is important. The nightly news can become frightening, but that's when you need to stay away from making emotional-based decisions. 3 of the major things you can control are your behavior, your risk tolerance or appetite, and your time horizon. It is often said that investors can lose more money by making bad decisions than they can from market declines. Short-term market movements are nearly impossible to predict, so that's why we share with clients that we believe in proactive planning with a well-diversified portfolio that considers your risk tolerance and time horizon. Your equity investments are long-term, and you need to be prepared that any given time they will go down in value. We encourage you to limit your exposure to inflammatory, upsetting media reports and news. Remembering you are invested for the long term can help you stay well grounded in times of volatility. An interesting fact that came across here the other day, the average time length of a bear market is 1 year. The longest bear market we've had in the last 125 years was 1972 to 1975, was 3 years. And I've talked about this many times. What the nightly news is doing versus what your portfolio is doing is two different things. And most people, if I don't, we're down probably 2 to 4% between depending on what kind of investor you are, conservative or aggressive. Some people are down 1.5. Some people are actually up a little bit on the conservative because the bond market's done well. So when the index is down 20, we're doing well through this. Once again, we encourage long-term investing. So as you unemotionally look at a 45-year chart of equity returns, we are once again reminded that over a 40, 30, or 20-year time frame, even with some very severe occurrences and downturns, historically, long-term investors have been rewarded. As a recap, here are some other things to remember. After 2 robust years for equities, the S&P 500 entered correction territory in the first quarter of 2025. The new administration brought many changes, including tariffs, which have had a significant impact on equities, and investors have experienced a rapid downfall. The Fed held the federal funds rate steady at 4.25 to 4.5, and as of March, they are still forecasting possible rate cuts in 2025. I believe that is still true here in April, but it's a wait-and-see game on these tariffs. Better than expected inflation numbers came in showing that U.S. inflation decreased to 2.8% in February, down from 3% in January 2024, and we also know they went down to 2.4% in March, from 2.8% in February. Bonds present a less volatile alternative to equities, an additional option for those looking to diversify their portfolio. Focusing on what you can control and minimizing your exposure to inflammatory news can help you stay well-grounded in times of volatility. Market declines are part of the investment experience, and maintaining the consistency for well-devised, long-term focused plans historically served investors well. And finally, remember, we are here for you to discuss any questions or concerns you may have. We've been doing that for weeks now as we go into the next quarter of meetings here in May and June. We're going to continue to do this. We're hoping we'll get more clarity here as we move forward. The Congress is working on dealing with all the tax cuts that are set to expire at the end of the year. We need to see them deal with that. We're expecting that somewhere in midsummer, June, July, somewhere, we hope. The longer they don't deal with this stuff, the more uncertainty that will create. The more we can get this uncertainty out of here, the faster markets will recover. Once again, thank you for your trust in us. One of our main objectives is to keep our clients informed, and we appreciate you taking the time to watch this update. Please feel comfortable sharing this update with anyone else you think can benefit from it. Have a super day. We'll talk to you all soon.